Stocks represent ownership in a company. Each unit of a stock is called a share. When you own a share, you own a small piece of that business. If you owned 50% of a company's shares, you would own half of that company and half of its future profits and losses. A shareholder is anyone who owns shares of a company. Shareholders may earn money if the company grows in value or pays dividends. Some shareholders also get voting rights on company decisions. A stock exchange is a marketplace where shares are bought and sold. It works like a digital auction where buyers and sellers meet. Famous examples include the New York Stock Exchange and NASDAQ. Investors cannot trade directly on these exchanges, so they use brokers. A broker is a person or platform that buys and sells stocks on your behalf. Today, brokers are mostly online apps and websites. A public company is a business whose ownership is divided into shares and sold to the public. These shares are traded freely on stock exchanges. A private company does not sell shares to the public. Capital refers to anything that provides value. This usually means money, but it can also include buildings, machines, technology, or intellectual property. An asset is something of value that you own and expect to benefit from in the future. Stocks, cash, real estate, and commodities are all assets. A liability is something you owe, such as loans or debts. Market capitalization, or market cap, measures how big a company is. It is calculated by multiplying the stock price by the total number of shares. Liquidity describes how easily you can buy or sell a stock. Stocks with high trading activity are more liquid and easier to trade. Volume is the number of shares traded in a stock each day. High volume usually means strong interest and better liquidity. A bull market is when stock prices are rising and investors feel confident. A bear market is when prices are falling and fear dominates the market. These terms come from how bulls and bears attack. Volatility measures how fast and how much prices move. High volatility means prices swing rapidly. Low volatility means prices move more smoothly. A bubble happens when prices rise far above their true value due to extreme optimism. Eventually, bubbles burst and prices crash back down. An IPO, or initial public offering, happens when a private company sells shares to the public for the first time to raise money. Dividends are payments made to shareholders from a company's profits. Not all companies pay dividends. Blue-chip stocks belong to large, well-known companies with strong track records. They're generally more stable and often pay dividends. Forex, or foreign exchange, is the market where currencies are traded against each other. Bonds are loans investors give to companies or governments. Investors earn interest and receive their original money back later. Commodities are basic goods like gold, oil, wheat, and natural gas. They're raw materials used across the economy. ETFs are baskets of stocks or assets that trade like regular stocks. Some track indexes, while others are actively managed. An index tracks the performance of a group of stocks. The S&P 500 tracks 500 of the largest U.S. companies. Options give investors the right, but not the obligation, to buy or sell an asset at a set price. Calls are for buying. Puts are for selling. Futures are contracts that require buying or selling an asset at a future date for a fixed price. Going long means buying a stock expecting its price to rise. Shorting means betting that a stock's price will fall by borrowing shares and selling them. A short squeeze happens when a stock price rises sharply, forcing short sellers to buy shares and pushing prices even higher. A long squeeze happens when long investors are forced to sell. A limit order lets you buy or sell at a specific price. A market order executes immediately at the best available price. A stop-loss order automatically sells a stock to limit losses. Averaging down means buying more shares when prices fall to reduce the average purchase price. Day trading involves buying and selling stocks within the same day. Swing trading holds trades for days or weeks. Value investing focuses on stocks that appear undervalued. Growth investing focuses on companies expected to grow faster than average. Technical analysis studies price charts and patterns. Fundamental analysis studies the company's business, finances, and industry. The P/E ratio compares stock price to earnings to estimate valuation. It is helpful but not perfect. Intrinsic value estimates what a stock is truly worth. Book value reflects accounting value based on assets and liabilities. Panic selling happens when fear causes massive sell-offs. A dead cat bounce is a short recovery before prices fall again. Pump and dump schemes artificially inflate prices and then crash them. Rug pulls are similar scams often seen in small cryptocurrencies. Whales are investors with huge capital who can move markets. Black swan events are rare, unexpected events with massive impact. Compound interest means earning returns on both your original investment and past gains. Over time, this creates exponential growth. Dollar cost averaging means investing a fixed amount regularly to reduce the impact of market swings. Return on investment measures how much profit or loss you made compared to what you invested.